Hi, I'm Dorian Lamb, and welcome to Season 2 of Start with the Close in Mind. In real estate, business, and life, the people who win aren't the ones who react. They prepare, they think ahead, they see the close long before the rest of the room does. After a year of conversations with top operators and decision makers, this season goes even deeper into what it takes to close deals the right way. We'll break down the strategies, the mistakes, the mindset, and the real stories that reveal how successful people navigate complexity and come out on top. Every episode brings insights from leaders who have been in the trenches and can show you the difference between hoping a deal closes and engineering the outcome from the start. This is Season 2 of Start with the Close in Mind. Let's dive in. Welcome, everyone, to the next episode of Start with the Close in Mind. Today's episode is something that gets talked about constantly, especially in New York real estate: financing. Everyone has opinions on what lenders want and what kinds of deals are getting done, but there's usually a gap between what people think they can get financed and what the market or lender will actually accept. So my guest today, Matt Sabanek, sits right in the middle of that. He works on the capital side, arranging debt and equity, which means he sees where deals actually work, where they break, and what sponsors are still getting wrong in today's market, based off of what the lender is actually giving. He's also built a reputation in affordable housing, lowercase a, we'll get to that, which from the outside feels like one of the harder areas to get financed right now, but Matt has some insight on that. So today, I want to get into what's actually getting financed right now, what operators should be thinking about early if they want deals to actually work. So Matt, welcome to the show. Let's start with some background about you and how you ended up on the capital market side of the business.
Yeah, Dorian, appreciate it and glad to be here. So I took a bit of a roundabout way to get here. I grew up with two parents who were architects and in the construction space. So I was always told I could never go into real estate. When I graduated college, I was looking for a job and I ended up finding something on the investment sales side. My dad always told me to stay as close to the money as possible. So I wanted to be where the transactions were. From there, I learned I had a bit more of a passion for the financing side. So made the switch, been doing this about a decade, and really just helping people, sourcing debt, structuring transactions, and helping people get to the finish line. I feel like in today's world, more so than ever, the getting to the closing is the hardest part.
Really interesting. So you've, in a way, come up in a real estate family, right? I mean, two architects, and then now you're bringing in the ability to actually get capital, right? So that's kind of an interesting evolution to the family. I wonder how you're going to pass that, if at all, to your family. But
we'll see if there's any interest with the kids. I don't know.
see.
They're a little young at this point. They got a little bit of time.
You got the design, you got the financing, they could fill in the rest.
Exactly.
So getting back to what you do, let's talk about the current market reality. Getting into current deals, what does it look like? What do deals getting financed right now tend to have in common from what you're seeing?
Yeah. So I think the common factor of the ones that are getting across the finish line are the clients who understand that this is still an evolving marketplace, that while the market feels back in certain ways, there's other ways that it isn't. And lenders are still licking their wounds from a lot of these deals that went sideways. So I tell people all the time, lenders get smarter in downturns than they do when the market's hot, right? Lenders just learned what sponsors they don't like, what assets they don't like, what business plans they don't like. And they're now trying to adjust how they lend to this ever-evolving environment. So a lot of my clients used to say, Bank X was my go-to, right? They did everything for me. And now Bank X is doing 50% of my business or 30% of my business or none at all. And I don't know what to do. And a lot of it is a sponsor's willingness to go out there, right? Explore new options, understand that there are moving pieces to this whole puzzle and that things are evolving, and really working with the team as a process to get to the finish line.
Yeah. You bring up an interesting point about lenders. What do you feel they're really looking for today?
So each lender is different. You know, we've been saying this other thing in the office for a while is that we're in the tale of two cities. You know, when I take out, and to your point earlier of lowercase a, rent stabilized, workforce housing type products, but specifically the rent stabilized in New York, there's a limited pool of lenders out there. You have a couple CMBS players, you have the agencies, you have a small handful of banks, but it's not a hugely overwhelming amount of optionality. It's really about finding the fit that's best. On the flip side, if you take out a free market building, there's countless options. You know, we just took out a free market building in Williamsburg and we had 16 bank quotes on the table versus a $21 million refi of a rent stabilized building up in Northern Manhattan and there was 6 or 7 quotes, right? And 2 or 3 of them were underwhelming. So I think what you're really seeing is lenders focus on better assets, better sponsors. They're looking for higher quality. They really want a lot of people looking to take that next step up in the beginning of the cycle and really do a better quality of deals.
Interesting. So depending on if it's free market or rent stabilized, in general, there are deals happening. And what you're describing is a lender with a heightened sense in general. And we'll call it just a higher benchmark now, whether it's on the sponsor side or the actual underwriting of the actual economics of the deal itself. So we're talking about, or the cases you've given are those that have worked. What are you seeing that's not getting financed? What's the contrast that you're seeing?
Yeah, I would say the bigger things in this market are missing paperwork for some of these regulated buildings, delinquencies and payments, both physical and economic vacancies. I think a lot of it comes down to how the building's actually operating. You know, I would say on the flip side, lenders are also more hyper focused on sponsor than they've ever been. We have deals that where the property is fine, but the sponsor had a number of foot faults and there's not great explanations. 5, 6 years ago, there'd probably be a huge pool of lenders for it. Today, that world is a lot smaller, and lenders are they want more professional outputs. They're looking for higher quality sponsors. They are much more sensitive to who they're lending to than what they're lending to.
Yeah, that's a good point, Matt. The paperwork, something that often I feel gets overlooked, right? Where do you just have things in order? It's a reflection of just even how you're operating the asset itself, right? And it kind of all trickles up in this case to how you're perceived by the lender. If you don't have anything in order, do you even have your property in order, right? So that's an important component.
Yeah, and I would say also it really depends on a refi versus acquisition, right? On a refi, a lender's going to want to see you be much more buttoned up than on an acquisition, right? Because a refinance, you've owned that building for a while and they want to make sure that you know what you're doing. Versus on an acquisition, look, the truth is there's a lot of these, right? Back in the day, the laws were different. You didn't have to keep paperwork for more than a handful of years, right? So there's a lot of these deals we see where these units were destabilized in the early 2000s, maybe the early when legally they only have to keep the paperwork for 4 years, so that paperwork's gone. And what do you do? Right? And there's this huge ambiguous question as to how these get financed. I will say we're starting to see some banks get more flexible and they are a little more understanding. It's really the equity that's having a more sensitive problem to those paperwork issues, and we're seeing a ton of that. I'm getting calls daily from clients who have these deals with these nuanced paperwork problems, and we're trying to figure out ways to get around it. And every deal is different, right? We could have 2 identical buildings next to each other. They each have their own nuances. So it's really about figuring out how to get that person to the end.
Yeah, so it's an interesting thing that we're talking about paperwork as an impediment to deals kind of not getting financed now or breaking. Is there anything from the asset class perspective that maybe not so much isn't financeable at all, but just generally, I remember a time, especially coming out of COVID, where if you said the word office or if you said the word retail, it was like, no way. I feel like the markets have opened up a bit, but do you feel like there is still an asset class that has what I'll say a challenge to getting financed?
Outside of rent stabilization, I wouldn't say there's an asset class. It's more location based, right? Like we're actually just got signed up on an office building yesterday that we're going to go refinance, and there's a bunch of options. I have a client who has one coming due in a couple months, and we've already started preliminary having conversations. And there are absolutely banks that will do it. Now they want to look at occupancy, tenancy type, collections, but as long as those things are in line, which I feel just working in Midtown every day, seeing the office market come back, right? I think a lot of these buildings do have better economics. I don't think there is a specific asset class. I think it's more location driven, right? So retail is hot right now. But if you have retail on a side street in Bushwick, right, that's going to be a little bit tougher to get done because it's more location focused, not necessarily asset. But if you have a retail, like I'm doing a retail condo down East Village, we have 12 bank quotes on it right now. There is absolutely interest for these kind of products. It's just about fitting the pieces together. Maybe proceeds aren't as high as you wanted. Maybe rates a tad high because treasuries are through the roof right now, but there's options. And I think that's a huge delta from the past 3 years. 3 years ago, there really weren't options. Today there are.
Yeah. Yeah. So it's going back to the old catchphrase, to use your term, of location, 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 right? Even
Oh yeah.
with lending, right? And even more so now in this market. So you mentioned treasury. Where do you see spreads now? Are they holding tight or they going either direction? Give us a pulse of what you're seeing, given that you're in the trenches daily with lenders and borrowers.
I would say spreads blew out 2022, 2023, you saw them widen, right? Pre-COVID and even, in 2020, 2021, we saw spreads in the 100 to 200 over range. 22, 23, we saw them really blow out. We were getting deals done at 250, 275 regularly, and those were the best rates we had in the market. Those spreads have really tightened since then. I would say your average spread right now is probably somewhere between 150 and 225 over. We have not seen spread compression has sort of stopped a little bit. But what was really helping for a while was the treasury decrease, right? So even if you had a 200 spread, as the
Yeah.
treasury went from 4.5 to 4 to 3.5, all of a sudden you saw a 100 basis point swing. Now with treasuries back up above 4, right, with the 5-year being just above 4 and the 10-year being in the 4.4, 4.5 range, that's a wide spread. Right now, all of a sudden you're looking at a mid 6% rate for your average deal versus 60, 90 days ago, we were getting quotes in the low 5s, even touching the high 4s with buy downs. Today, unless you have a very unique special deal, I don't think you're getting there.
Yeah. Yeah, interesting the dynamic of spreads. I feel like that's like the news.
Yeah.
It's tied, to the news and it can change or the weather if you want to think of it from that perspective, where just so many components that are out of your control that really impact that.
Oh yeah.
So we've talked about deals that are getting done, deals that don't get done. We've talked about location. Let's dive into affordable, right? Because you do have experience there. And I do want to qualify this with something you taught me in the prep for this call, which is the difference between a capital A affordable and lowercase a affordable. So why don't we start from there? I think that's an interesting insight that many around me aren't aware of.
Yeah, 100%. So at Ariel, we are one of the largest affordable housing sales brokers in the city. So we see a ton of affordable projects come through our door. And affordable can mean a range of things, right? It could be all the way from what you mentioned, capital A affordable, that's LIHTC, that's government, bonds. That's when you get intervention from the government to help keep it affordable, whether it be on the tenant side or the sponsorship side. Lowercase a is more what we consider workforce housing, rent stabilized units that are affordable for their market, more so than being restricted in any way other than maybe the rent stabilized space. I would say in the capital A affordable space, there's a lot of money, right? New York has a real focus on preserving affordable housing. They want to grow it, especially under this mayor. So we see a ton of interest. We have a lot on the sales side. We have a ton of inventory that Vic and Shimon are selling, and we have buyers who are eagerly looking to get into that. On the flip side, on the lowercase a side, you have a lot of these rent stabilized deals where we're getting a handful of them done, but they're a lot tighter. Cap rates have moved pretty dramatically. We just got a commitment letter on one yesterday where my client's buying it for a going in 9 cap with upside on the retail. So a lot of it's also coming down to what is the value of these things? How do you underwrite them? What do delinquencies look like? How are collections? Will there be future issues? And that's really where it gets a little ambiguous and tougher to understand. We're still seeing plenty of it. We're still getting term sheets and signing term sheets. I will say those are much more rate sensitive because a lot of them are over leveraged on the refinance side, and people are really trying to wade through how to take those out.
Yeah. And as a side note, Shimon has been on the show, so we've had some pretty
Oh, yeah.
strong representation from Ariel Property. Thank you guys. So that's an important delineation. And you showed or you gave some brief insight with regards to some of the components that are elements or impediments of the rent stabilized type deal. What are you seeing that, give us an example of a deal that has worked in that space, just, as a case study.
Yeah. So we are about to sign term sheets on a deal right now. It is a rent stabilized portfolio up near Columbia. What's interesting here, and I think we talked about this earlier, right? How retail used to be a bad word, right? I remember pre-COVID, we were talking the death of retail. Even post-COVID a little bit, we were talking the death of retail. And to me, retail, I think a lot of people, retail's come back stronger than ever, right? It sort of changes face. We change how we look at it, but it is, right? Things are getting occupied. So what was interesting with this deal, it's a mixed-use building. There's about 30% of the income from retail. And of the remaining 70%, about 60% of it is rent stabilized. So we sort of changed the narrative, right? A lot of people look at that as a 60% rent stabilized building. We said it's not. It's really a 60% free market building because we considered the retail free market, right? There's no regulations on that. You could do what you want. There's upside, there's leases. So we tried to look for creative ways to position it differently to lenders so they don't just look at this as any generic rent stabilized building. They see that only 40% of the income actually comes from stabilized units, and the other 60% is between the retail and the free market. So that got some interest. We had a couple of bank quotes. Ultimately, it sounds like we're going CMBS there just because we're proceed driven. But a lot of it's getting creative. And how do you structure it? How do you position it in a market that doesn't like stabilization? On the flip side, I'm doing a deal on the Upper East Side for a long-term third generation family group. It's a 20-unit building. 6 are stabilized. Had them destabilized for years. I had multiple lenders tell me even one stabilized unit is too many. Now, that one,
Yeah.
we're still doing fine. We had 10 quotes on it. We ended up picking a very strong offer, but that was the feedback we were getting. And it's hard because so many buildings have one stabilized unit in it. I
Yeah.
don't know if you saw, but Fannie and Freddie actually just changed their underwriting guidelines. Ironically, right after Mayor Mamdani got elected, pretty much say that if your building has one or more rent stabilized units, it goes for pre-review on top of they're doing a special exit test underwriting to make sure it works. So people understand what they are. They're hyper fixated on it, and everyone's trying to figure out a way to get deals done by still protecting themselves.
That's so interesting, the perspective of it too, right? Where, there's always two sides, and you guys are helping to, get some traction with regards to, yeah, in a, 20-unit building, or let's just say 10-unit building with one rent stabilized, it's actually 9 free market units, right? So that's I see an important kind of separation between how people viewed it before versus now. But at the end of the day, there are still the stigma behind rent stabilizers even having one, but you're seeing them to get done. I actually don't remember the last time I remember hearing rent stabilized and CMBS in the same kind of sentence as far as something getting done. So it gives you an example of that these types of deals can be possible because just quite frankly, anecdotally, joke, not so much joke, but the feeling behind anything that has rent stabilized on it is pretty much doomed, right? Especially here in New York. But you're seeing those deals get done, right?
Oh, 100%. And I will say lenders may be pulling back a little on proceeds. They may be hiring increased DSCR. They may be looking for more comforting metrics, but they're still trying to there's still plenty of lenders in the market trying to figure out how to get these done. And it really is just deal by deal, understand the metrics, understand the situations, and right, how we get someone to the solution.
Yeah.
On the flip side, we're seeing a lot of deals that are in default, right? Especially in that stabilized space. And what we're seeing there is a lot of lenders working with the sponsors to get out, right? I think lenders are also acutely aware that these are not simple deals. They just can't put pressure on their sponsors to sell these things and make them whole, right? There's a reality to this. So we have a number of deals where the lenders are actually involved in the sales process. They're on the sales side. They're on the sales calls, and they are giving guidance as to what they will and will not accept in terms of a write down of their principal balance. But I think that's important because that wasn't really happening 6 months ago on a large scale, maybe here and there, but not as what we're seeing it today. And to me, that means everyone understands what these are and they're all trying to make it work together, right? So
Yeah.
even the lenders are saying, hey, let's get the most money possible, but get it off our books and let someone else deal with it.
Yeah. That's really important insight, especially of how that's changed over the past 6 months. So there is this kind of understanding that, or at least an effort to understand the rent stabilized component of a deal and trying to figure out a way to get it financed.
Oh, yeah.
Yeah. So, you know, as everyone knows, the name of the show start with the close in mind, right? So I do want to use your expertise here in terms of, what should operators be thinking about earlier today if they want financing to actually line up in the way that they expect and want?
Yeah. I think they need to start having conversations with their lending partners sooner, whether that be broker or lender. I think what we see a lot of our sponsors are used to a world where don't worry, it'll get done. And they wait till the last minute to get diligence over, and then that leads to issues. I would say transparency, being upfront, right? Especially if you're working with a broker, like tell them what the issues are because our job is to help solve them, right? We want to work on your team, not adversarially. I would say the other thing is the head of paperwork, right? Make sure you understand what the legalities are, understand the nuances, speak to your attorneys to understand what can and can't get done legally and what is going on the government side. We had a deal that was supposed to be a sub rehab on the Upper West Side. Middle of the deal, some news broke that made it feel like we would not be able to do a sub rehab on this deal anymore. We pivoted to townhouse conversion. but it took a couple weeks to get there, right? There was a lot of conversations with attorneys to understand the nuances, understand the new rules and regulations, and how to get through it. I think sponsors need to be much more communicative, working with their network, working with their service providers, because, right, I'm working on 40 transactions at a time. I have clients that haven't done anything in 3 years. They just don't know how things have changed. So really working together, working as a team, I think those are our most successful deals.
Yeah. I'm going to summarize that to, use the experts, use the advisors, have the conversations early. Don't feel like you can get it done on your own. Right. And I always say that. Right. And, off that preface, it's, where can people find you, Matt? Because I feel like many people should be talking to you early.
Yeah, 100%. So you can find me on LinkedIn, Matt Sabanek. You can email me first initial last name at arielpa.com. So MDZBANEK at arielpa.com. And feel free to call me.
Awesome. So today's conversation really comes down to something simple. There's what people think they can get when it comes to financing, and then there's what actually gets done. The difference usually comes down to structure, having your paperwork, timing, understanding what the market is actually willing to accept. But all of that can be solved by speaking to an experienced advisors. That's why experienced advisors matter, like Matt. Matter like Matt. There you go. The earlier
I
you
know.
involve the
You
right
steal that.
people, you should. The earlier you involve the right people, the earlier you understand what works and what doesn't, and where adjustments need to happen before it's just too far in the deal. So, Matt, thank you so much for being part of the show today. And I hope the audience learned something new. Thank you, Matt.
Appreciate the time, Dorian. Looking forward to talking more.